Hi there. If you're thinking about gifting assets to reduce care fees or tax, this guide clarifies how deprivation of assets rules really work.
Hi everyone, and welcome to this explainer from My Tax Accountant, where we make sense of UK tax and finance. Today, we're diving into a massive financial trap that so many families fall into. It's all about the massive confusion between inheritance tax rules and paying for care home fees.
Okay, I want you to picture this. You've heard the advice, you've done what you think is right, and you've gifted your home to your kids to give them a secure future. 7 years go by, and you breathe a sigh of relief thinking you're clear of inheritance tax. But then, way down the line, you find yourself needing long-term care. Can the local council really turn around and claim the value of that house? The answer, incredibly, is often yes. And you absolutely need to understand why.
And believe me, the stakes here are incredibly high. By 2026, the average cost for a care home is expected to be almost £1,300 per week. That's over £67,000 a year. It's a staggering figure that can literally wipe out a lifetime of savings in the blink of an eye. You can see why people are so desperate to protect their family home.
So to get our heads around this, here's how we're going to break it down. We'll start with the big fear that drives all these decisions. Then we're going to bust the massive myth around that famous 7-year rule. We'll look at the council's hidden powers, the serious consequences of getting this wrong, and then, most importantly, we'll talk about smarter ways to plan and what your next steps should be.
You know, the great fear for so many families across the UK is that everything they've ever worked for, their home, their savings, is just going to be swallowed up by care costs. Because the system is means-tested, your entire financial life gets put under a microscope.
Just look at how quickly you're on the hook for the whole bill. If you've got assets over just £23,250 in England, you are what's called a self-funder. That means you pay for 100% of your care. It's only when your life savings have been drained all the way down to that level that the council even starts to chip in. This is the financial cliff edge that makes people desperately search for a way to reduce their assets.
And that desperation leads us straight into the biggest myth in estate planning. So many people believe that just gifting their assets away is the solution, and they hang their entire strategy on one very famous rule, the 7-year rule for inheritance tax. It's a rule pretty much everyone has heard of, but it is dangerously misunderstood.
For inheritance tax purposes, the rule itself is pretty clear. You make a big gift and is called a potentially exempt transfer. If you live for a full 7 years after making that gift, it becomes completely exempt from that 40% inheritance tax. If you pass away inside that window, the tax is charged on a sliding scale. This whole timeline is what people think about when they think about gifting.
But here it is, the most crucial point of this entire explanation. If you remember just one thing, make it this. When it comes to the council assessing who pays for your social care, the 7-year rule is completely, utterly, 100% irrelevant. It does not apply.
And this slide shows you exactly why. You see, we're not playing one game here. We're playing two, with two totally different rulebooks. On one side, you've got inheritance tax, run by HMRC, with its strict 7-year clock. On the other, you've got care fees, run by local councils under the Care Act. And look at the differences. They have no time limit and can look back as far as they want. And most importantly, while HMRC cares when you made the gift, the council only cares why you made it.
This brings us to the council's hidden power, a legal idea called deliberate deprivation of assets. This is the very tool they use to challenge gifts and transfers that you might have made years or even decades ago.
So what is it exactly? Well, the official definition is when you intentionally get rid of your assets, your money, your property, for the specific purpose of paying less for your care. The key word in all of this is intentionally. It all comes down to your motivation when you made that transfer.
And to figure out your intention, the council applies a simple 3-part test. First, was it foreseeable? Was it reasonable for you to think you might need care in the future? Maybe you just had a new diagnosis. Second, what was your motivation? Was avoiding care fees a big reason for making the gift? And third, expectation. Did you know that care is means tested? If the council thinks the answer to these questions is yes, they can rule that a deliberate deprivation took place.
And let's just be crystal clear on this because it's probably the most shocking part. Unlike the IHT rule, there is no time limit, no 7-year, 10-year, or 20-year safety net. A council can investigate a gift you made at any point in your past if they think it was done to avoid care fees.
So what happens when this all goes wrong? What are the actual real-world consequences when a council investigates and decides, yep, this was a deliberate deprivation? Well, the financial fallout for the whole family can be absolutely devastating.
And this isn't just theory. This quote here is based on what happens to countless real families. A family does what they think is right, only to be told years later that the gift doesn't count, and now they're facing a massive bill for care they can't afford, and then the council suggests they go ask their own children for the money back. It's a nightmare scenario.
So let's look at how they recover the costs. First, they use something called notional capital. This basically means they assess you as if you still have the money you gave away. Simple as that. That pushes you straight over the limit, and bam, you're a self-funder who has to pay for everything. But what if you physically don't have the cash? That's when they can go after the person who received the gift, your son or daughter, and hold them liable. And if all else fails, they can take legal action through the courts.
Now, I know this all sounds incredibly bleak, but it really doesn't have to be this way. The key is not to avoid planning, but to plan smartly and legitimately. It's about changing your mindset from how do I hide my assets to how do I structure my estate properly. It's all about knowing the difference between a high-risk gamble that will probably fail and a solid legal structure that's recognized and accepted.
A perfect example is how you use trusts. A high-risk strategy you might see advertised is the Lifetime Asset Protection Trust, where you stick your house in a trust while you're alive. To a council, that's a massive red flag. It often screams care fee avoidance and can easily be challenged. A much safer, lower-risk strategy is a protective property trust that's written into a couple's will. When the first person passes away, their half of the house goes into the trust. The survivor can still live there for the rest of their life, but that 50% share is now protected from their future care fees. It's a legitimate, powerful planning tool.
And here's a professional tip from us at My Tax Accountant. It costs nothing, but it could save you everything. If you make a large gift, document your reasons at that time. Write a letter or an email that clearly states why you're giving the money. Maybe it's for a house deposit or to help pay off a student loan. If the council comes knocking 10 years later, that little piece of paper showing a non-care related reason could be your absolute best defense.
Okay, we've covered a huge amount of ground, so let's just boil it all down to the key things you need to remember to move forward with confidence.
Right, here are the 5 things you absolutely must take away. Number 1, the 7-year rule is for tax, not for care. 2, councils have long memories and no time limits. 3, it is all about your motive. 4, getting this wrong has severe consequences that can hit your children directly. And finally, number 5, safe, effective planning is absolutely possible, but this is not a do-it-yourself job. You need professional advice.
And of course, it's so important that we add this disclaimer. This explainer is for general guidance only. These rules are incredibly complex, they can change, and everybody's personal situation is different. So please, it is essential that you get professional advice that's tailored specifically to you before you make any decisions.
You know, the goal of all this planning isn't just about saving money. It's about getting peace of mind. So the final question is, are you ready to stop worrying and start planning with real confidence?
If the answer is yes, then we're here to help. You can see our contact details right here on the screen. Give us a call or send an email to My Tax Accountant, and we can set up a consultation. And please don't forget to subscribe to our YouTube channel for more clear, simple explainers on the financial topics that really matter. Thanks so much for watching.